Hey everybody, thank you for joining today. Sorry for the little bit delay. We're a little bit afternoon here. We're figuring out some little technical difficulties, but we are back live and we have a great presentation for you here today. Today we have Michael Plaks. He's going to talk about a little about taxes and IRA investments on syndications. A lot of the questions that we get for people when they call us every single day and they want to make a new syndication investment, they ask, well, what are the tax implications? What should I know? And we can't necessarily give that tax advice. Well, we bring in CPAs to do that for us. So before we get started, I also want to reiterate that Quest Trust Company this year is hosting a massive event. We used to do it in the past. COVID put a pause to it, but we have it coming up in September. And I want to show you guys a snippet of what that looks like, because I believe that everyone looking for this kind of education, everyone on this video or watching it later, is going to really find this event advantageous. Victor, go ahead and show them a little about what we got going on in September.
Coming to this expo is such a wonderful learning experience. There are hundreds of other real estate investors to network with and to learn from. The education is such a wide variety in any type of real estate investing that you're interested in. You're going to learn it here.
So visit questexpo.com for more information. That's just a snippet of the last one that we had. The one we're putting on this year is going to be even bigger. It's going to have more vendors, it's going to have more people, it's going to have more speakers, it's going to have a lot more time allocated to education and networking specifically. So if you're looking for deals, if you're looking to find investors, if you're looking just for educational purposes, it's really a place to go. It's not an IRA related entire exposition. It's real estate, alternative assets. We'll have oil and gas, we'll have energy, we'll have, of course, real estate, private entities and such. So take a look at it. Right now we have early bird pricing that goes on to the end of April. So get your early bird ticket now, because if not, you'll be paying more later on. And there are also discounts. Steve will put his discount code there in the chat box for you guys. Go to questexpo.com, use Steve's code on the early bird price and get an extra incentive, an extra discount on that ticket, and be ready for the event in September. Without further ado, I'm going to go ahead and introduce Michael Plaks. Michael, just go on and show your screen here. I'm going to put you in the screen. There you go. Thank you for joining.
Okay. Always a pleasure to be here, and collaborate with Quest. Thank you for having me. And today we're going to talk about the most boring topic we can possibly choose, income tax. But heck, that's what makes or breaks your bottom line. So we do have to talk about it, and we specifically talk today about passive investments and syndications. So before I start my presentation, is just need to explain, like, my look is okay, and my logo, which will appear once I start sharing, show me punching this guy standing behind me, Uncle Sam, who is social distancing behind me. So we beat him up, and that's what I wear to do that, my black belt, because I'm known as black belt in real estate taxation. So now gloves are off. Okay, I'm going to talk about some tax rules. I'm going to share my screen right now, and we're going to start this presentation. Okay, so what we're doing is, like I said, talking today about passive investments and syndications. So, everything is okay on the screen?
Oh. Yes, everything is all good on the screen. Okay, you see it now.
Okay, then I'll go on. It's okay. So, I'll start with brief introduction. So, like I said, I'm known as Black Belt in real estate taxation. I'm a federally licensed enrolled agent, which is a highest federal license in taxation. I'm doing that since 1996. And what could be the most important part here is I work exclusively with real estate investors, helping people like you with tax strategies. Before we do, of course, we need a couple disclaimers. After all, that's tax presentation. First one, this is not tax or legal advice, so you cannot sue Quest or cannot sue me for that. Your mileage will vary. What I mean is we are going to talk in generics, discuss general principles, and when your situation happens that actually could be different, you need your own personal tax advice. Speaking of personal tax advice, no, I won't be able, especially now during the heat of the tax season, answer your questions one-on-one. So I apologize for that. Cannot answer individual questions if you are not our clients, but there are ways to contact me, which I will mention towards the end, where questions could be answered. Okay, and if you're asking about even consultation with my firm, unless you're our client in our advisory program, we really cannot even offer consultations one-on-one. But like I said, I will mention where you can get more information on the topics we are discussing. And one more sort of disclaimer is on this picture. We are living in a country where we take financial advice from a cartoon characters on screen. So hype is what it's all about. But I don't like hype. So my presentation is going to be the opposite of Geico style. I'm going to dispel and destroy myths and stay away from all hype. So now finally to our agenda. So what are we talking about today? We are talking about syndications, passive investments in syndications specifically. And I'll start by talking about general concept of what syndications are and what they are not when we talk about your overall business plan and return on investment. Then we'll proceed and talk about the tax angle related to syndications. Syndications, as most of you have heard, generate losses via form that you receive once a year called K1. So the question is, can you actually take those losses as the sponsor of your syndication promised you? Next thing that we will discuss there, syndications have a large tax issue with capital gains. And the question is, what can you do about them? Can you delay those taxes and how? Next one, many of you have heard how cost segregation enhances tax benefits of syndications. We will talk about that. We will also talk about other special tax issue having a real estate professional status and how that correlates with passive investments and syndications. We'll talk about this one where once you network with people online in real life, you will see people bragging how syndications made them wealthy while saving them from taxes. And I do have to comment about how much truth there is in these statements and why these people are saying that. And of course, being hosted by Quest, we cannot sidestep. This very important topic is what happens when syndications investments are placed inside self-directed IRAs. So that's basically our agenda, and we'll go straight into that, starting with the business or return on investment aspect of syndications. So anytime you invest in real estate, there are basically three reasons. Okay, they are on your screen, and we talk about appreciation, which we equate with building wealth, cash flow, which is current income, and then there are tax benefits. And in my opinion, this is the right order of importance when you evaluate your benefits. So what happens with syndication? Now I'm making controversial statement that immediately raises objections in some of you. I know that, guys. So I will explain myself and we will take it from there. Okay, so why I'm saying syndications do not build wealth. Okay, we're not going to spend a lot of time on that, but I want you to ask yourselves two questions about that. First is, can you sell or borrow against your syndications? The answer is no. You cannot sell your investment in syndication. You cannot borrow against that. But you can do it if you actually own assets. So what you do own, you don't own assets with syndications. What you do own is interest in that partnership structure. And even that interest that you do own, you cannot control. So that's why I'm saying is this is not really the same as owning assets directly. Owning assets directly, you can control, you accumulate wealth, you accumulate equity in them. There is no equity that you accumulate in syndications. All you have is an interest. So what basically syndications are, and I'm going to move into taxes on the next slide. We don't have time to spend a whole lot of time talking about those details. But what syndication investments really are is a game of income and more so short-term income. Short-term meaning is a few years as opposed to like decades or sometimes unlimited holding period that you have or you are going for when you accumulate assets that you own directly. So it does not mean that this is bad, but I want to be very clear when you are for the first time considering syndications, it's very different from buying your own assets. By your own assets, I mean your own single family homes, your direct investments in apartment, multifamily properties, in commercial properties. Those are assets. Syndications are different. You invest for a relatively short period of time. You don't control it. You can generate cash flow, like some syndications more focusing on value add, some more focus on cash flow, some on both. So you have that aspect. So if we look again up the slide, and we have three reasons: appreciation, cash flow, tax benefits. We don't have appreciation in the syndication itself. Inside the syndication, there is possibly appreciation. However, it's not normal. It's not common. You don't invest for 3-5 years for appreciation most of the time. So appreciation is really not there. Cash flow is what mostly syndications are about, and it leaves at number 3. So what about tax benefits? That's the rest of the presentation today that we are going to talk about, and we are moving there. So tax angle of syndications, okay? What is happening there? So as I already mentioned, in syndications, you have relatively short holding period, normally 3 to 8 years. Of course, there are always special situations, but I'm talking about like most of the syndications that you are dealing with and we are dealing with as tax people. So 3 to 8 years, you are exiting out of syndication, which usually means that a syndication that invested in a property will sell it. And when you sell a property, there is a gain. Now, if they sell a property, there is no gain. Well, you need to ask questions, not tax questions, investment questions. Normally, when you invest in a syndication, you expect at the end of that cycle to have a significantly higher sale price than the acquisition price of that asset at the front. So you will have big gain. Every time you have gain, the guy who is standing behind me, Uncle Sam, will remind you, gain means you have taxable income, you means you have more taxes. And then if you heard this, but what happens before you have the final year where the syndication sells the asset and has gain? So before, like from that start and until that final year, what you have is several years of ownership where the syndication passes to you tax losses. And next bullet answers frequent confusion is yes, taxes and cash distributions are not the same. It is completely possible. In fact, it's common for syndications to distribute cash to the investors over those early years while simultaneously passing down to them tax losses. So how that happens, we will not go into technical details. Again, this is more of an overview presentation today, but do keep in mind, this is completely true. You can have cash distributions while simultaneously having losses for tax purposes. When we are talking about these two parts, cash distributions and tax losses, as far as cash distributions, I'll make this comment. It's actually not always a good thing from a syndication to redistribute cash distributions like your preferred returns and whatever else they structure to distribute to investors. If the syndication is healthy, yes, it's definitely a good thing. If the syndication is generating enough cash flow to distribute it to shareholders and investors. But some of the time, some of the syndications actually mask their poor performance and distribute cash when that cash is not really earned by syndication. So be careful about that, which is not really a tax issue, but I did want to mention that because we talk to a lot of new investors who consider investments in syndications, and they are very easily seduced by the promise of distribution. And they're saying, see, the first 2 years we are getting good distributions. Well, good distributions do not necessarily mean that your syndication is doing well. But I digress, that's not really our topic today. So what the sponsors of syndications do not tell you, however, about the tax losses, is there are two very, very important things for you to remember. In fact, if you forget everything else that I talk about, I would want you to remember these 2 points from today. Number one, the losses that they can distribute to you through those K1 forms, you may be unable to take them. Yes, I'm going in a minute to talk more about that. Right now, I'm just mentioning two biggest issues. So number one, yes, you do have losses, but you may be unable to take them. Two, at the end of the cycle, at that last year when you have your gain, you might have to return those tax savings from the losses anyway. So when you're talking about losses, well, is it good to have tax losses? Generally, yes. But with syndications, you need to remember two things. Number one, you may be unable to take those losses. And number two, those savings from the losses, even if you are able to take them, you might have to return in the last year of syndication, which makes those losses far less attractive than the presentation that you hear initially from some of the less upfront sponsors who do not give you the full details. So next we are going to talk about, this. So I'm talking more about your ability to deduct these losses. And what we are looking at right now is a strange picture. It's strange unless you, like me, happen to grow up in the Soviet Union. Then that picture and the cartoon behind that would be immediately recognizable. For everybody else, I have to explain. So this is a culturally iconic cartoon in the former Soviet Union. And the characters on the screen, guys, bear with me. This is relevant to our tax conversations. So the characters here are the three smaller characters are having great time of their life in their summer house, spending summer vacation. So the dog, the cat, and the boy are enjoying their life, but they have no adult supervision. And the old guy in the picture, it's the rural mailman who every day comes to their house with this parcel that he holds under his arm right now. And that parcel is addressed to these guys who are having their vacation. And he delivers it every day to their house because he says, look, guys, this is my job. However, he cannot give them the parcel because the guys don't have an ID on them. So every day he comes, brings the parcel to them and takes it away because he cannot verify their identity. Guys, this is what happens with those K1 losses. Every year you have that parcel. Every year you may be unable to take them. So why is that happening? So what K1 syndication losses represent is called in the tax language passive losses. Okay, and what passive refers to is that's a specific IRS term. It does not mean you don't do anything, even though in case of syndication as a passive investor, you're not supposed to do anything. But even if you did something related to that syndication, if you are, for example, attending meetings and reviewing reports, doing all of that stuff, well, you are still having passive losses. And by the IRS rule, that guy behind me tells you, you can only use passive losses to offset passive income. So, and besides that, as the next bullet point says, you still can only offset it down to zero. So if you have passive income, you can raise it down to zero, not below. You cannot create passive loss using those things. Okay, now, if you have other passive income, for example, passive income from your rental portfolio, then yes, you can take syndication passive loss and remove non-syndication passive income doing that. Yes, that you can do. But what you still cannot do is, if you don't have any passive income, if you just have this syndication, it only has a loss, there is no passive income. You don't have any benefit from that loss. Specifically, I want to pay attention to what we are talking about right now. You guys who are high income earners on the call right now. Syndications are very heavily promoted, for example, to medical professionals. So doctors like hate the amount of taxes they have to pay every year on their W-2 income, and I know, like, I I can sympathize with that. However, syndication laws cannot do anything to offset that income. And even if you're on 1099, if you're a high producing realtor and you have a lot of commissions on 1099, same thing. Syndication losses cannot offset that income. They can offset passive income. W-2 is not passive. 1099 is not passive. You cannot offset that income. And some people immediately say, yeah, I know that's for high income earners. But I don't have high income. My income is below 100,000, because many times when we talk about passive losses, we talk about the passive activity loss rules, and we talk about ability of most people to take up to 25,000 deduction. So if you heard that, that part is true, but it's true in the context of rental properties, not syndications. Syndications do not have this rule. Syndications cannot have 25,000 deduction even if your income is even if your other income is below 100K. If you had 25,000 loss from having your duplex that you own directly, oh yes, that you could use to offset your 100,000 W-2 income. With syndications, no matter what level of income you have, low or high, losses from syndications cannot offset W-2 or 1099 income. It works differently. It's not the same as with rental properties. So then the question is, so some of you may be thinking right now, yeah, but my sponsor was specifically selling me on those losses. The point of having investment in tax syndications is those tax losses, okay? I know, I've heard those presentations myself way too many times, guys. I know what you are talking. So number one, as I said several slides ago, tax benefits never should be your primary reason to invest to begin with. So you should have other reasons to invest. Performance of that syndication, which is its cash flow, and maybe appreciation of underlying asset. But what you are looking for is return on your contributions. You are looking at value add performance of the syndication, not tax benefits. Tax benefits are icing on the cake, but it's a huge icing saying sponsors, look at all those losses. Look, especially you guys who are high income earners. It sounds very attractive. So why are they saying that when I just told you that this is not true? So we're going to look at a couple reasons why. Reason number one, themselves, people who are telling this to you, they are sponsors of the syndications. So the syndicators themselves have different rules. Their income from syndication is not passive. Their income is active because they are sponsors of the syndications. They actively work in it. So they are not restricted by the same rules that apply to you as a passive investor in syndications. So some of them, looking at their own taxes, just cannot even understand or cannot even think about the rules that apply to them might or actually will not apply to their investors. So that's reason number one, simple not understanding that the rules that apply to them is not the same rules that apply to you. Okay. Second is they do not bother to learn about taxes. You know, just our general deficiency of tax education across the board. Just because they are sponsors of a syndication, hopefully they know a whole lot more than you do about syndicating. But it doesn't necessarily mean that they know a whole lot more about taxes than you do. A lot of syndicators and sponsors are very ignorant about that. So you cannot really rely on their information. Okay. Third is many of the investors they might have dealt with in the past could be what we call special tax situations. Some examples are on your slide right now. Example is now, if you have passive income to offset, well, then losses from syndications are helpful. You might have multiple syndications and have strategies that involve investing in multiple syndications. Yes, there are some very effective tax strategies involving multiple syndications. Now, they may have directly owned portfolio in addition to syndication, which might open the door to other tax benefits. So all of those are more complicated special tax situations. But in a very straightforward situation like this, you are a W-2 person. You work on W-2 having full-time job. You invest in one syndication, have no other real estate investments. Losses from those syndications are not available to you. I'm sorry, they are not. Okay. Fourth reason, unfortunately, very common one. Some syndicators and sponsors on the less ethical part of the spectrum, and that part does exist, are aware of the fact that many of the investors cannot use their losses. But if they disclose that fact during the initial fundraising presentation, well, that doesn't sound nearly as attractive as promising big losses. What happens later? Well, later you will be upset, but they can try to deflect, and they sometimes do. We know that because we are the tax professionals and say, well, I don't know. Maybe your tax professional doesn't know what they are talking about. No, I'm pretty sure that we know what we are talking about, and that's a deflection technique that some sponsors use for unethically raising capital without disclosing things that they know about but choose not to disclose. All reasons above that, however, are maybe they really don't realize what is happening. Well, there is one more reason, is eventually, like I said, those losses, I said you cannot use them. Does it mean they are wasted, like completely thrown into trash? No. Eventually, those losses will become unlocked. When you sell your, not when you sell, in the last year of syndication, when the syndication sells the asset. So when the syndication sells the asset, yes, at that point, even if you could not take the losses before, in the final year, you can catch up. So you can use those losses to partially offset future gain. But it still would not help you in all of the years before the very last year. And in the last year, it's still not going to reduce your W-2 taxes. It's only going to offset part of the gain. But it is true if they say to you that, we maybe you couldn't take losses, but no big deal. You can still take them eventually. True, but it's still a big deal. It needs to be disclosed. So next one, okay, continuing with that. So I many times mentioned that last year of presentation, last year of syndication. Let's talk about that a little bit. So at the end, the syndication sells the asset. Yes, of course, I need to specify. There are a lot of different types of syndications. Okay, there are some syndications that do not invest in value-add properties. But for my example, I'm referring to a typical syndication which buys a distressed property, something like an apartment complex, restores it into much better condition, increases rates, rental returns, reduces vacancy, improves the quality of the property, increases therefore the value of the property, and 3, 5, 6 years later sells that property sometimes at 2-3 times at what they purchased the property for. So that's what we are talking about. So at the end, the syndication sells that asset, and the sale creates capital gain. And when you have capital gain, you pay taxes on those capital gains. It's getting worse. Getting worse because in addition to that capital gain, most people at least are somewhat aware of. So if they bought that apartment complex for 2 million and they are going to sell it eventually for 4 million, okay, that from 2 to 4, yes, that's a 2 million capital gain, which will be distributed between all of you passive investors. So yes, that part is more or less clear, but there is that hidden part which could create just as much tax hit. In addition to the capital gain itself, it's depreciation recapture. What depreciation recapture means is all this depreciation that you have taken in the years leading to that final sale, all of these year number 1, 2, 3, 4, okay, you took all of these depreciation deductions, and in the final year, by the IRS rules, you have to reverse that. All depreciation that you have taken during this time has to be returned and create a tax on depreciation recapture, which, by the way, is even at a higher percentage rate than the capital gain tax. So you will have to deal with both capital gain on the increase in the value of the property that the syndication sold, plus taxes on all of the depreciation you previously took. So you take a deduction first, which sounds very good, and assuming you could take the deduction, and at the end you have to return it. So in addition to that, one thing to remember is you don't choose when you sell the property, at what time. If it's your own property, you can play with your tax strategy and choose a better moment maybe to sell the property. With syndication, when the syndication sponsor sells it, that's when you have that gain. So you cannot choose the better moment for you to do that. Okay. And now comes the worst part. Many people on the call prior to that bullet that just appeared on the screen were thinking is, oh, well, I know I invested in multi-family properties before. It's not a big deal. Yes, I've heard about depreciation recapture, heard about capital gains. All I do at the end is I do a 1031 exchange and I kick that can down the road and it's fine. Guess what? Cannot do it with syndications. Syndicated investments cannot go into 1031 exchange. Sorry if I'm ruining your Saturday with this news, but this is the true IRS rule, and we cannot really get around that rule. There is one exception. The exception is that there are some syndicated investments that are not structured as limited liability companies, which most of them are. Some of them are structured as what is known as tenants in common syndications, tenant in common type of investment, where you are not a member of a limited liability company, but essentially a partners owning that property in split chunks. Now, those syndications exist. They are fairly rare compared to traditional syndications that are limited liability companies. They have higher initial investment thresholds because they are more expensive, more complicated to set up, more complicated to manage. So if you absolutely need to use a 1031 exchange as your exit strategy, you will have to collect enough investment capital to qualify for one of those higher threshold tenant in common syndications and specifically look for those. So yes, if you go there, you can indeed do 1031, but for most syndications, you cannot. And is there anything besides 1031 exchanges to avoid paying capital gain tax when the syndication sells it? The answer is yes, maybe. They are more rare, more complex, and they are all case by case. Example is, as of today, we are still using, in some cases, opportunity zone funds. They are much less attractive today than they sounded when they first introduced 4 years ago. So there are much less interest in them, but they still exist. And in some situations, they are a good way to do. There are a couple other strategies, but we don't have time for that. That's something that you would need to discuss with your own tax strategist or tax advisor to see if in your case you can do that. Other than that, you need to focus on that third bullet from the bottom that says cannot do 1031 exchanges. That means at the end of the syndication cycle, expect to have a major tax hit, assuming, of course, that your syndication performed successfully and did create significant gain on the back end. Okay, cost segregation. which is often marketed as a huge enhancement to tax benefits of syndication. So what is cost segregation? In case you are not familiar with that, this is not a presentation about cost segregation. Quest hosted several presentations in the past about cost segregation. So you can find those in their archives. And there is a lot of information about cost segregation in general online. Like I have many podcasts where I was talking about that. So there is a lot of information you can find. So we're not talking about the details. All I'm going to mention right now is how cost segregation fits into the syndication concept. So first, cost segregation, when it's done, is nothing but a form of accelerated depreciation. So all again that cost segregation does, it accelerates your depreciation. So yes, if you don't know what cost segregation is, I'm just using two big words that are meaningless: segregation, depreciation. Right, I'm sorry, we don't have time during like today, we don't have time to go into explanation what it is. So look it up, but I still want you to have basic understanding from this slide is whether cost segregation is something that you should be excited about when the sponsor starts talking to you about that. So again, this is accelerated depreciation method, which is absolutely true when your sponsor says, yes, it increases your deductions. When you increase your deductions, you increase your losses. Yes, that part is true. Cost segregation can dramatically increase your first year deductions for depreciation. And I stress first year. Most of that happens in the first year. So then what's bad about that? Sounds great. But here is always but. That but says this. Number one, we accelerate depreciation. We don't create it. We accelerate it. So what it means is we're just stepping into the future and taking in the first year depreciation that you otherwise could have taken later. You just eat your dessert first. That's what happens. So it's not more food on the table. You just start getting to the end of the meal immediately. Okay? Nothing wrong with that. You say, I agree. I also like to eat dessert first sometimes. But unlike your dinner situation, is depreciation you have to return. So when you do cost segregation, you take more depreciation. Guess what? In the last year of syndication life, you have to return more depreciation. So you take more, you return more. What's the end result? Zero. All depreciation that you are taking, you have to return when you sell the property. With syndication, you don't have 1031 exchange to kick that can down the road. So what you have to, 5 years later or whenever the syndication finishes with its cycle, you have to return your depreciation. So what if they take cost segregation? Well, you just have to return more at the end. Yes, you take more at the beginning and you return more at the end for the same net result. So when you look at that whole concept, so what depreciation really is, and I want all of my followers, everybody who listens to my seminars, always remember depreciation is a loan. Yes, you can take it and you return it. Then what cost segregation does is it gives you a bigger loan. You just take more money up front, but you have to return bigger loan at the end. It's still a loan. Okay. Besides, none of the loans are free. You have to pay for cost segregation study. You have to pay for cost segregation tax preparation. All of those cost money, particularly cost segregation studies. On commercial properties, they can get fairly expensive. And as an investor in syndication, if syndication and says, yeah, syndication says, I will do cost segregation. Yeah, but who pays for that? You pay for that. The cost of cost segregation study is also spread between passive investors. So you are paying for the privilege of having a bigger loan that you have to return in the end. So then the question which naturally raises is, okay, so why would we even do that? Am I saying that cost segregation has no place in syndications. No, I'm not saying that. Hold on, we're getting there. So, what are conventional benefits of cost segregation? Conventional, I mean, is without syndications. Is okay. So, what is the reason to do that? So, yes, number one, you can often take bigger losses. So, if you can take losses, cost segregation can create bigger losses. That's good. Second point there says as well, yeah, we know we need to return it, but meanwhile, we are holding the money and we can use it better, called time value of money. Very valid consideration when you're talking about any tax losses, including tax losses from cost segregation. Yes, it's good to have more cash. You can invest it. You can do things with that money, and later you return it with devalued money, especially now during inflation period. It's even more of a time value of money issue. Good. Third one, 1031 exchanges normally allow you to not worry about capital gain taxes when you sell. Again, look, those are conventional benefits. That's why cost segregation is a great tool in many situations when you buy direct ownership in commercial properties or apartment complexes. But that's not what we are talking about. We're talking about syndicated investments. So how those 1, 2, 3 translate into syndication world? So number one, remember we talked on syndications, you usually cannot take losses. Okay, so what happens if they do cost segregation? Now you have bigger loss that you cannot take anyway. You couldn't take small loss, now you have big loss. Neither one you can take. How do you benefit from that bigger loss? You don't. Number two, time value of money. Well, if you cannot take losses, you didn't get any savings. There is no time value of money because you did not get any tax deduction to talk about. And we already talked about how 1031 exchanges are not available for most syndications. So if you compare that, it sounds like first one says, yeah, cost segregation sounds pretty good. And the second part of the slide says, but not for syndications. Is that what I'm saying? Not quite. What I'm really saying is this. Cost segregation can be great for some passive investors in syndications. We will talk in a little, like in a moment, mention a couple situations when it could be. So, but not for everybody. That's what's important to understand. If you are one-shot investor in a syndication, meaning is you have high income from your W-2 job or your real estate commissions or something else, and you bought just one syndication, and you have no other real estate investments, just that one syndication, and you don't plan to do anything else with as far as a real estate investor, then cost segregation most likely will be useless to you. Okay, so be careful with that. When they sell you on those benefits, it's not beneficial for everybody. You may be in the group where it's beneficial, but more often than not, it's not beneficial for passive investors. You need to very carefully evaluate your situation with your tax advisor to figure out what will be the net result on your tax situation. Okay, so one more benefit that a lot of people are talking about, real estate professionals, and yeah, we don't worry about all of those limitations. Who cares? I can be a real estate professional. I read about it. It's a loophole. Loopholes are great, and we're not going to worry. Yeah, let's see if we have chance to not worry. So first, again, just like with cost segregation, we don't really have time to discuss what real estate professional status is. But the bottom line of that is, if you are a real estate professional, what you're allowed to do is you're allowed to take losses that normally you are not allowed to. And sometimes, for example, that would be the case if you are a high income earner, you cannot take any passive losses, zero. So, but if you are a real estate professional, then you can take as much as you want. Sounds terrific. So let's all become real estate professional. Okay, we have a lot of people who contact my firm and saying, okay, so how do I become real estate professional? No, you can become a realtor. You cannot become a real estate professional. Those are two different things, because real estate professional is not about being licensed realtor, even though a lot of IRS auditors are trained to believe that nonsense. No, it has nothing to do with being a realtor. It has nothing to do with the number of properties. There are specific tests in the IRS rules that you have to pass. And you cannot become real estate professional. You either qualify or you don't, based on those tests. We don't have time today. It's outside of our syndication topic. We're not talking about how to qualify. I just need to mention those two things to address at least some of the anxiety that you might be right now experiencing about that status. If you have full-time W-2 job, you cannot qualify as a real estate professional in most cases. W-2 full-time job kills that. However, if you are married, only one spouse need to qualify. So if you have W-2 job, your spouse does not, your spouse might be able to qualify, and then both of you can get those tax benefits. Okay, great. So wonderful. We're going to take the spouse, make her into real estate professional to satisfy all the rules. Before you do that, I have to give you a warning that I frequently give on consultations to my clients. I'm saying this. Before you approach your spouse and tell her that you want her to start managing all of your properties and to qualify as a real estate professional for tax benefits, make sure to ask her if she is interested in that. Otherwise, pretty soon you might not have a spouse and won't be able to qualify anyway. So just remember that life is ahead of tax benefits. Okay, now, here is the bad part when we talk about syndications. If you notice, there is a pattern today. I'm talking about how tax benefits exist in a general world, but not so much when we come to syndications. And here is that one more situation like that. On syndications alone, you cannot qualify as a real estate professional. And some people think, but I'm invested in 10 syndications. Doesn't matter. You can invest in 100 syndications. If all you have are syndications and you are a passive investor, if you are not a sponsor, if you are a sponsor, completely different game. All presentation today is for passive investors. If you are a passive investor in syndication, you cannot qualify as a real estate professional. You need something else to qualify for real estate professional. Like if you are also a realtor, if you also have direct ownership in other properties, yeah, those things might qualify. So if you are already a real estate professional from something else, not from syndications, in some cases, again, some cases, not all of them, but in some cases, you can piggyback your syndications on top of being real estate professional in something else and kind of like stick them into the same bucket and possibly get deductions from them. Beware that even if you are a real estate professional, you still may be unable to do that with syndication. It's case by case. Now, if you all, again, but very important to remember, if you only have syndications, forget it. You cannot be real estate professional anyway, even without W-2 job. Okay? 2 slides left and we are done. Syndications inside self-directed IRAs. So inside of self-directed IRAs, this is what happens. Before we talk about tax benefits, general reminder, which Quest, I'm happy to report that Quest is one of the few companies that actually is upfront about this very important point. Some of the new investors believe as well, I'm just going to invest inside my self-directed IRA and I will avoid risks of losing money. You don't avoid risk of losing money. You still buy the same investment. So instead of your retirement account can lose money. Well, guess what? It's still your money. So you cannot remove risk. You cannot improve your syndication performance by investing in syndication through self-directed IRA. If it sucks, it will suck both ways, with your personal money or retirement money. So business always comes first. That aside is syndications have 2 parts, as we talked about. You have losses for several years before it sells and gain at the end. Losses for self-directed IRAs are pointless. Even if you could take them, you don't need tax losses inside self-directed IRAs. That defeats the concept. Okay, self-directed IRAs protects you from gains, but you cannot get benefit from losses. So losses are not needed. However, the great part there is gains you're not worried about. If you're invested in self-directed IRAs, or I phrase it wrongly. If your self-directed IRA is a passive investor in syndication, when eventually you have those big gains at the end, including depreciation, recapture, and whatnot, guess what? You don't have taxes because it's inside your self-directed IRA. So that part is definitely good. It's getting better. There is bonus. Bonus part is it's pretty hard. Like if you are following Quest seminars, you heard a lot about prohibited transactions and why they are not great. Guess what? It will be pretty hard to create prohibited transaction when you invest in syndication. So it's a very safe investment from that point of view. One more bonus. You can easily invest in the same syndication both from your personal money and from your self-directed IRA and not create a problem with that. Very good benefit. So what at the end of the day, many syndications are excellent vehicles for self-directed IRA investments. Not all of them, there are always exceptions, but strongly consider syndication investments inside your self-directed IRAs. After that, talk to your tax advisor. And my last slide is talking about, okay, how you heard about all of these people who brag about having no taxes on syndications, and I just talked for almost an hour about not having those benefits. So who is right? Am I lying to you? Are they lying to you? Well, neither. Neither one of us lying to you. It's absolutely possible and absolutely real. Then you can invest in syndications and pay zero taxes. But, okay, so first, remember that syndications usually cannot offset your W taxes. In fact, at the end, you will end up paying more taxes. The whole cycle of syndication ends up in a gain. So if you look over the lifetime of syndication, syndication increases your taxes. So that's generally how it works. So what strategies do we have to avoid that? Strategy number one, we just talked about that. You can invest in syndications inside your self-directed IRA. Second strategy, you can invest in multiple syndications. There are strategies that you need to work with your tax advisor where you sell one syndication at the same year investing into a different syndication, and that can, when done right, create very significant tax benefits and possibly eliminate those tax negatives that we talked about. There are many investors among our clients who are using those strategies. Third one, you might be able to use losses from syndications to offset income from your other investments like single family homes or apartment complex that you own directly. The other way around, you might use losses from other investments to offset gains from syndications. Most important strategy number 5 is, in order to know what helps you in your specific situation, you need a really, really good tax planner, tax advisor. And if you happen to not know one, I can have a suggestion. Okay, that would be Michael Plaks, yours truly, who is a black belt in real estate taxation, federally licensed enroll agent, was doing that since 1996 and working exclusively with real estate investors. Happy today to present for you. In order to contact me and my firm, okay, on the screen there are 2 websites. REI Tax Firm is my tax firm. REI stands for real estate investments, even though recently we got a phone call in our firm. Somebody was looking for bicycle tires, thinking that we are part of our REI retail store. No, REI is real estate investment tax firm. Our website, reitaxfirm.com. My personal educational website is michaelplaks.com. And if you have direct questions, as I said before, if you are not our client, we won't be able to address individual questions, but you have 2 other ways. You can post it on Bigger Pockets, where there is a tax and legal forum, and I'm one of the top contributors to that forum. There are many colleagues of mine there, and we take turns answering questions there. It's free. And on Facebook, there is Tax and Legal Wizards Facebook group that I co-host with tax attorney John Heyer, and we answer questions for free in that tax group. With that, thank you very much again for my friends at Quest who host this presentation and many others. and who are providing such a great service to many clients of ours. And that's the end of my presentation. Thank you, guys.
Thank you, Michael. That was a fantastic presentation. I learned a lot. Every time I watch one of these things, I learn one more nugget. And so, if you don't mind, I know we started a little bit late. Do you mind answering maybe just a few questions?
Sure.
General questions.
Oh, answer to general question has general answer. General answer is always, it depends. That's it. Okay.
Well, let's see what we can do here. So, one early on, one guy mentioned if you were not able to offset previous years, when we're talking about offsetting, years 1, 2, 3, and 4 with depreciation, do you still have to reconcile those losses in the final year that you close?
Yes.
Okay, so even if you don't, you still have to reconcile.
You mean like if you let make sure I understand the question. The question is if you are unable to take losses.
Correct.
Okay. It still works out the same. Okay, let's think about it. Let's say that you have 10,000 loss for the first 4 years. 10,000, 10,000, 10,000, 10,000. So you can take the loss. So you can take the loss of 10. You benefited in the first year. You can in the second year, you can take 10,000 loss. You benefited, saved money in the second year. So for 4 years, you saved the money. Then when your year 5 comes and the syndication sells it, now you have to pay taxes on this 40,000 of prior benefits. Now, what if you could not take losses? Then you had no benefits for the first 4 years, no savings. So what you do is those 40,000 reduce your gain in the year 5. So either way, at the end of the game, it's a wash. So either you were taking losses for 4 years, but then you return them by increasing your gain, or you don't take them, don't increase your gain. So, but at the end, it washes each other. Either way.
Understood. And so another question here. A lot of the listeners today are IRA holders, and they may be invested in syndications through their IRAs, as you mentioned, and I think also a pretty solid deal with IRAs. But they do run into the issue of UDFI specifically. Any, I guess, tips when you incur UDFI that can be a solution to that taxation, or at least mitigate it?
Yes. Okay. But I'll have to be brief, that's technically a long discussion. Okay. So what one is talking about, and all of you assume, guys are Quest clients, or at least at a minimum Quest supporters and followers. So you have heard that even though normally self-directed IRAs do not have taxes, they do have taxes in 2 situations. The self-directed IRA pays taxes, either when they are involved in unrelated business. That's not a problem with syndications, known as UBIT tax. Syndications do not create that problem. But they do create another tax, which is one was talking about, UDFI, which is a tax when you invest in syndication with borrowed money. When your self-directed IRA borrows money in order to invest that in syndication. Yes, there is potential tax. Okay. The best mitigation tool for that is do that investment inside self-directed 401k instead of self-directed IRA. Self-directed 401ks do not have that UDFI tax. They don't have to deal with that. The problem does not exist. If you are unable to create a self-directed 401k, then it has to be one-on-one, exploration of what you can do inside your self-directed IRA.
Right. So just to recap, there is solutions, and solo 401ks absolutely eliminate the need for it. But of course, not everyone qualifies for the solo 401k. So if you are an individual that does not qualify for that and is already in an IRA, unfortunately, the best answer is speak to your tax strategist, because there may be ways to help and still.
Yeah, the word there will be mitigate. That will not be, if 401k eliminates the problem altogether, then in case of IRA, the problem cannot be eliminated, but maybe can be mitigated. And sometimes the tax is not really that as big as some people fear, because it's only calculated on the portion which is financed, And that stuff gets a little technical for us to talk about.
Yeah, absolutely. But yeah, I definitely agree. It's a lot less than what people really think it's going to end up being. So definitely consult. We'll wrap it up very quickly. One person asked, is the REI tax form taking clients nationwide?
Yes.
Okay. Answers yes there.
Yes. My firm, REI tax firm, yes, we serve clients nationwide. We do everything remotely. So yeah, we have a lot of Houston clients, but we haven't seen them in the office for years. Like even before pandemic, no, like we can do everything remotely. One thing we are not doing is we are not working with international investors. Everywhere in the US, not a problem, but international investors, we do not help.
Perfect. And the last question I'm going to ask here is, it says novice question, but there are no novices questions. It says, any other advantages when using SD, Roth, and traditional IRA over cash? Anything we have to watch when filing taxes at the end of the year? And I can also put some input in that too, but maybe you want to answer it first.
No one. Like, why don't you? That's your bread and butter.
Well, what I would answer this is saying, when you're using an IRA or a Roth IRA, like we spoke about and like you spoke about in the presentation, there are advantages, right? You don't have to necessarily worry about taxes as long as UBIT and UDFI are technical things, but for the most part, you won't have to worry about taxation. And then the biggest thing too is you may already have that 401k IRA money ready to be deployed. And like Michael said, you can utilize both cash and IRAs in a passive syndication opportunity. So it's not necessarily should I do one or the other, it's do I have the opportunity to use my retirement savings for the syndication for its growth purposes. So that's kind of the idea. I wouldn't necessarily say one's better than the other. I say they're different opportunities. It saves you from having to take the money out of the IRA account and pay taxes now. That's what we're ideally really trying to avoid right now. But yeah, that's how I would kind of look at that.
Yeah, from my perspective as a tax advisor, yes, like I just completely agree with one, rephrase it slightly, just slightly change when we have that question about investing inside the retirement accounts versus individual investments. Every time you do that, that has to be looked at holistically with your overall plan. There are some investments that work best inside self-directed IRAs. Some investments work best outside. There are rules of thumb, but rules of thumb are, when I did live presentations in the past, like I always would tell my audience, okay, show me your thumbs, and people do that. I'm saying, look around. Do you see that all thumbs are different? You cannot have rules of thumb. Our thumbs are different. So why normally, like you would say, is okay, private lending is very good for self-directed IRAs. Syndications are very good for self-directed IRAs. Rental properties are not that good normally for self-directed IRAs because they are already tax advantaged investments. Okay, so sometimes backfire. So does it mean, can I simplify and say is okay, direct ownership outside IRA, private lending and syndications inside IRA? No, that's oversimplification. Sometimes it's the other way around. Sometimes it's all case by case. But if you really, really need to create some overly simplistic and possibly incorrect rule of thumb, then yes, syndications in self-directed IRA could be better than syndications outside of self-directed IRAs. Could be. Not always, but could be. There are some excellent strategy of investing in syndications outside of self-directed IRAs.
Right. Yeah. So, I mean, this one more last comment here said UDFI is a big thing. Why brush it under the rug? And I want to kind of address that because we're not necessarily brushing it under the rug. It's just a situation that you need to speak to a tax strategist about. And when you sit down and run the numbers and look at the deal, look at your profit, look at your gains and what you actually owe taxes on, you may see that the investment still made profits. The investment's still in the green. And out of experience seeing a lot of these investments on a day-to-day basis, a lot of clients of ours, we do see that they are going upwards and they're not losing all their gains because of the taxes. You may be paying Uncle Sam, which sounds counterintuitive. However, you're still making ideally, if everything's great, a solid deal.
No, 100% one. In fact, one of my first slides said is 3 reasons to invest in real estate, and they were appreciation, cash flow, taxes, number 3. Don't switch the order. Don't focus on taxes ahead of investments. And sometimes, even if you have to pay taxes, it's still a good investment sometimes.
Yeah. Well, Michael, I thank you for your time. I want to tell everybody that, check out his website. That's where you're going to find more information. We're going to be able to contact him and his team. If you're interested in kind of, can they service you or what their rates are, I highly encourage just checking it out. It is a Saturday. And so I want to let, Mr. Plaks here, I took his time out of Saturday to get back to his day. If you have any additional questions, you can absolutely reach out to him, or you can even reach out to Quest Trust Company. Myself will be happy to answer any questions for you. You can email us, Steve. Go put this in the email for us. You can email irishspecialist@questtrust.com. And Michael, what is your website again?
I think it's on the screen right now. Can you see it?
Go ahead and share it. Oh, there it is. And then that's Michael's website.
REItaxfirm.com is the website of my firm. So that's the best way to get in touch.
All right. REItaxform.com, michaelplaks.com. So use that. Steve there you go, irishspecialist@questtrust.com. If you want more information, this kind of stuff we do every single week. So thank you guys for joining again. If you're interested in kind of networking events and such, like I mentioned in the beginning, check out the Quest Expo. Super simple, questexpo.com. Thank you, Mr. Plaks, for your time.
Okay, thank you, Juan. Always a pleasure. Thanks.
Thank you.
Thank everybody who attended. Just stayed with us on a Saturday for an hour. I appreciate everybody. Stay safe and do well in your business and your life.